You know all the market volatility we've been seeing? Just noise. What if, right now? I know. Today we're going to break down the case from Tom Lee, one of Wall Street's most noted strategists, who thinks the market has room to run for another 10 years.
Okay, Lee isn't just hinting at a good year or two. No, he's talking about a potential super cycle that could stretch way into the next decade, all the way to a very specific year.
And that year is 2035. According to Lee, this is not some random guess he pulled out of a hat. It's the projected peak of this whole new market cycle. How do you even land on a date that specific? Well, the answer doesn't start with spreadsheets and algorithms.
So, the first and most powerful part of his argument has very little to do with quarterly earnings reports or what the Fed is doing. It's about demographics, this massive, slow-moving force of generational change that, according to him, is the real engine driving the market.
His point is, if you really want to understand the long-term tides of the stock market, you've got to stop looking at the daily headlines and start looking at the calendar of human generations.
Look at this. Major market tops have consistently lined up with the peak influence of a generation. You saw it in 1999 with the boomers, you saw it again in 2018 with Gen X. The millennial generation's peak is still over a decade away. Okay, so this leads us right into the next piece of his thesis. And this part is all about psychology. It's about how they see the world. And Lee argues there is this fundamental disconnect between who holds the wealth and who's actually driving the future. And this slide just lays out that conflict perfectly. On one side, you have the established, wealthier investors, and they're naturally skeptical, right? Their whole worldview was shaped by the dot-com bust and the 2008 financial crisis. But Lee's whole point is that markets aren't driven by that memory. They're driven by the disruptive energy of the youth, who see opportunity, not just risk. And this brings us to Lee's third big point, the idea that the entire market is basically infected with a powerful case of recency bias. You know, those shocks from the pandemic and all that high inflation are so fresh in our minds that they're coloring our entire perception of what's coming next. Lee argues that all this lingering skepticism isn't a bad thing. It's actually the fuel for the next leg up, just sitting on the sidelines. And that's exactly what allows the market to keep climbing that famous wall of worry and positively surprise everyone. Okay, so let's dive into the objections. Because this whole bullish idea doesn't exist in a vacuum. There are huge, well-known risks out there that could absolutely derail the whole thing. So how does Lee's framework even deal with them? First up, the biggest force in global finance, the Federal Reserve. The big concern here is that political pressure could mess with the Fed's independence, and that could create a ton of instability that just ripples through all the markets. Now, Lee totally gets how critical Fed independence is, but he argues the market itself kind of acts as the ultimate referee. Markets hate instability. His point is that they will react so negatively to any hint of losing independence that political forces will have no choice but to back off. In his view, it's more short-term noise than a real threat to the bull case.
The U.S. national debt. I mean, the numbers are just staggering, and a lot of people see it as this giant anchor that's eventually going to drag down the whole economy.
Lee's counter to this is fascinating. He argues that we're only looking at one side of the ledger, the debt side. The U.S. government owns trillions of dollars in assets, from its gold holdings and national parks to the postal system, that are valued on the books at pretty much zero. When you account for this big balance sheet, the country is way less indebted than it looks.
So, if this bull market could actually run all the way to 2035, well, the number one sign of a top is the exact opposite of what we have now. It's widespread euphoria. Lee says that in meeting after meeting, clients still dismiss his views because, he's always bullish. That level of skepticism is proof positive that we are nowhere near the kind of mass belief that you see at a market peak. So here's your checklist for a real market top. Either a major policy shock, like the Fed just slamming on the brakes, or an oil spike to some unthinkable level, or you get excess speculation, where margin debt soars and literally everyone you know is telling you have to buy. And maybe the most important piece of the whole puzzle, it's not just about trying to predict the market's direction, it's about how you should think as an investor inside of it. And that's really the question I want to leave you with. Lee's point is that true conviction, the kind that lets you ride out all the inevitable volatility, it comes from truly understanding and believing in the individual companies you've decided to own.